I hope that we're doing well today. Today, we're starting kind of like a series on looking at, double entry bookkeeping. Uh, and in doing that, we'll be looking at a number of specific things. We'll be looking at, the accounting cycle, which is what we'll be beginning with. We'll be distinguishing between cash and credit transactions. We'll try to define what credit and, debit is. We'll look at how to record transactions in journals, how to post those transactions into our ledger accounts, and would understand how to balance the accounts and distinguish between expenditures. But for today, we're going to be starting with the accounting cycle. When we say the accounting cycle, if you haven't watched the first video on accounting equation, on introduction to accounting, if you haven't watched introduction to accounting, please go to that video and watch introduction to accounting, because it would be a very useful basis for this recording. In recording, we had introduced what accounting is, and we had said that accounting is we identifying economic events, recording those events, and communicating those events to people who are interested in accounting information, so that they are able to make informed decisions. Okay, so the accounting cycle therefore entails we first of all identifying the transactions, identifying the economic events, the relevant economic events, being able to identify those transactions, recording those transactions in the journal entries, posting them in the, in the ledger accounts, then in the trial balance, and finally in the financial statement, preparing the financial statement. In this particular lesson, we'll be focusing on the first two elements of the accounting cycle. So we'll be learning to identify transactions as well as recording those transactions in the journal entries. Okay, cash and credit transactions. What do we mean by cash transaction and what do we mean by credit transaction? When we say cash transaction, we mean those transactions that we engage in that will make payments immediately. Those transactions we engage in that we make that would we receive the goods or services in exchange for money. So either we paid money immediately for the goods or services, or we offer services, or we give people goods and then they pay us money immediately. Those are called cash transactions. And for example, here we have Timmy sells goods for cash, 750. It means the goods, say for example, the goods that Timmy is selling is apples. So Timmy has sold this apple in exchange for cash, and the cash was paid to him, immediately, 750 pounds. Credit transaction, on the other hand, are those, transactions we go into that we engage in that payment is deferred to a later date. So kind of buy now, pay later. So we buy now, but there's an agreement for us to pay later. Or we sell now, and there's an agreement for the buyer to pay us later. So we use someone's money to buy the goods in that sense. Because we have in possession those goods or services, but we haven't really made payment for them. The payment has been deferred to a future date. So for in this example, we have Wilma sells goods on credit, 48 pounds Fred. So here's a credit sales where Wilma has given away the goods, but then Fred hasn't given an immediate payment of money. That payment of 48 pounds has been deferred to a future date. So that's just the difference between cash transactions and credit transactions. So when we have all of these transactions, don't forget we said that accounting is you identifying those transactions, identifying those economic events, and then being able to record them. So what does the record process then entail? It entails us being able to identify the two accounts. So if we look at this example, we have, there is Wilma selling goods on credit to Fred. There is Timmy selling goods, to we don't know who the customer is, but for cash. So you want to first of all be able to identify the two accounts. What are the two, aspects of the transactions? We then need to be able to then post that to the ledger, apply the double entry rules. We'll be discussing a lot more about the double entry shortly, and then we'll balance the account. So first step is to identify the two aspects of the transaction. Secondly, we decide if, we decide which of the 5 groups of accounts they are. Which of the 5 groups of accounts they are. Is it an asset? Is it an expense? Is it an income? Is it a liability? Is it a capital? Has there been an increase or a decrease? Has that be, has there been a reduction or there's been an increase, and then we then apply the double entry. So those are the 4 stages that would be using, in posting, in recording transactions into the journal entry, into the journal books. So identifying the true aspects of the transaction. Before we go into all of that, let's start with the double entry principles. So we have what we call the double entry principles of double entry, or the rules of double entry. So what that means in accounting is that for every transaction that we have, 2 sides of an account have been affected. So the debit side is being affected, the credit side is being affected. In fact, what the double entry rule says is that for every debit entry, there is a corresponding credit entry. For every debit entry, there is a corresponding credit entry. So if you have a journal entry is you recording your financial transaction. That's it. So you do a journal entry, for example, for every transaction you have, there are 2 sides of the account that has been affected. So you need to identify, you need to identify those sides of the account, and we need to record those sides of the account. And those sides of the account must be balanced. So both the debit side and the debit credit side must be equal. They must be balanced. So for every debit entry, there must be a corresponding credit entry. And that's what the double entry principle says. We'll see how that, what we mean by that as we go on. But before we go on, please, just to recap again, in one of the last videos on accounting, when we're looking at accounting equation and accounting terminologies, we had, explained each of these key terms. Please, if you haven't listened or watched that video, I would recommend that you go watch the video on accounting equation and accounting terminologies, where we had explained each of these key terms, because now they will become very relevant. Okay. So what are the rules for recording debit and credit entries in the 5 groups of accounts? So initially I said that we had 4 stages. You want to identify the transactions. You want to know which of the 5 groups of accounts have been affected. And then you want to know, has there been an increase or a decrease? And then you know how to record that in the journal entry. So the 5 groups of accounts we had referred to is, we have the assets, we have the expense, we have the expense or withdrawal, we have the income or revenue, and we have the liability and capital. All of these we had explained in the initial video. Please watch that if you haven't. So if there is an increase in assets, so what we try to do is look at some of the examples of assets, which we have done in the existing video, where we had defined what assets is. We have classified and said into current and non-current, and we have looked at examples of assets. So please watch that video if you haven't. So, but if there's an increase in assets, so if there is a transaction and we see an increase in assets, or we see an increase in our expense or our drawing, those accounts would have a debit entry. So if there is increase in assets, expense or withdrawal would have a debit entry. If there is a decrease in assets, expense or withdrawal, what would be a credit entry. If we have an increase in our liability, so liability or our capital or our income, if there is an increase in liability, capital or our income, those accounts, they would be a credit entry. But if there is a decrease in liability, capital, income, we make a debit entry. What do we mean by that? Let's go to, let's just have a simple example of that. So in this example, we have ABC Limited purchased a computer for £1,000 in cash. So ABC Limited purchased a computer for £1,000 in cash. We said that, the first step is for us to first identify the 2 aspects of the transaction. The 2 aspects of transaction that we see here is that there was a purchase of computer. So ABC Limited purchased a computer. So now ABC Limited has a computer. But in order to get this computer, ABC Limited had to give out £1,000 in cash. So we have cash was exchanged for computer. So those are the 2 aspects of transaction we need to identify: computer and cash. Okay, so next step. So step 2 says that we need to decide which of the 5 groups of accounts, is this transaction that we have identified. Computer is an asset. Please refer to the other video that we had discussed terminologies. Computer is an asset. Cash is also an asset. Why computer is a non-current asset? Your cash is it's a current asset. So we have both of them being assets, so we don't have a problem for them both being, in the same class of account. But you see that this assets, computer as an asset, was increasing because now we have a computer that we didn't have before, or maybe an increase in the number of computer that we now have. But then what reduced was the cash, because we had to give the cash in exchange for the computer. So this cash asset decreased. If you remember the rule we had said earlier on, we said if there is an increase in assets, if there is an increase in assets, there will be a debit entry. If there is a decrease in assets, there will be a credit entry. So we apply that same rule now. So it means increase in assets, we debit it, we debit, this account, we debit this amount, the computer purchase that we have, the computer, and then we would, credit the cash account because the cash account has reduced, but we now have a computer. So we would have in the journal entry, and we said the journal entry is just you recording your financial transactions. We have the date of transaction, we have the transaction, so the description of the transaction, and we have the debit and credits. On this date, computer was purchased, so we have an increase in computer, an increase in assets, we have debited that £1,000. Cash has reduced, and cash is also an asset, and we say reduction in assets is going to the credit side, and that's simple, I know. Okay, so let's go to the next example. Let's try another, example. We'll try 5 examples more, but I want us to take note of the steps. So the first step was, first of all, we identify the types of, the aspects of transactions that they are. In the previous example, we saw that they were both as, computer and cash. So you identify them. Then what groups of the accounts do they fall into? And then was there an increase or decrease? And then we then apply the double entry rule. Double entry rule says for every debit entry, there is a corresponding credit entry. So let's start with the first example of, ABC Limited paid rent of £3,000 in cash. ABC Limited paid rent of £3,000 in cash. So just give me a moment. I want to. So ABC Limited paid rent of £3,000 in cash. ABC Limited paid rent of £3,000 in cash. What I want us to do then is to be able to, post this transaction. We want to post this transaction. ABC Limited paid rent in cash. So the first thing we need to do is identify the 2 aspects of transaction, which is here we have rent and we have cash. We have rent and we have cash. We have rent and we have our cash. So I will just go. What we're going to do is we take each of the steps, and which is the reason why I have decided to share these 2 screens. So the first one is, ABC Limited paid rent, £3,000 in cash on the 1st of January 2020. So the 2 aspects of the transaction that we need to identify is rent and cash. So we do that. Step 1, identify the 2 aspects of the transaction. We have cash and we have rent. The next step is decide if it is a asset, expense, income, liability. What class of the account, of the groups of accounts is it? We know that rent is an expense. Rent is an expense, so rent, expense, and cash is an asset. You identify that. Question then would be, is there an increase or a decrease? Is there an increase or a decrease, in this class of accounts that we have identified? You agree with me that for rent, there's an increase in rent expense, right? So there's an increase in rent expense, there's an increase, but there is a decrease in cash, because for us to be able to occupy this, building, for example, we had to pay the landlord cash of £3,000. It means our cash level has reduced, so our cash decreased. So we have cash, which is an asset, decreasing. Apply the double entry rule. If you remember, we said if there is an increase in assets we debit, but if there is a reduction, a decrease in assets, we credit. So cash, which is an asset, has decreased. In this case, we're then crediting it. We also said if there is an increase in expenses, withdrawals, then what we increase it. And when there's an increase in increase in assets, expenses or withdrawals, that what we do is with debits. But if there's a reduction, we credit. So in this sense, rent was increased, which is an expense, we're going to debit it. The second example is ABC borrowed £2,000 bank loan. £2,000 bank loan. That was what ABC borrowed. So here, in this case, we have cash. ABC now has cash of £2,000, but there's also, a liability, which is the bank loan. Bank loan. So we have now two aspects of transaction here. We have cash of £2,000, but we have borrowings, bank loan of also £2,000. So the two, aspects of transaction will be cash and bank loan. We know that the bank loan is a liability. It's an obligation that it has to be paid. And then the cash is an asset. So we now, ABC Limited now has £2,000, that can be used for anything. So that's an asset. That's an asset. So that's a resources, just as we defined assets, that can then be used by ABC Limited. So we have identified assets and liability. Asset has increased. So now there is increase in cash of 2,000. Increase in asset, we say what you debit. And liability has also increased. And we said that, increase in liability in your income, in your liability, in your revenue. If there's an increase in income, liability, or revenue, you're going to credits. Credits is going to be a credit entry. So here we have credits. The third one says ABC Limited sold goods worth £4,000 in cash. Now this is cash sales, right? We have, okay, I've identified it already. So the two aspects of the transaction is we have cash, receipt of cash, and there's been a sales, the sales of goods. So we have cash and sales. In this case, sales has increased. Sales has increased, and sales is an income. Sales is an income, a revenue, because we, when we're looking at the accounting terminologies and we had discussed income and revenue, we said, sales is an income. It's when you sell maybe goods or services, or you offer you sell goods or you offer services in exchange for cash. In this sales of cash sales, so sales is an income. Cash, on the other hand, is an asset. And here, cash asset has increased. Sales has also increased, right? So if you remember our rule deciding when there is an increase or decrease, what do we do? So the double entry rule. So we say if we apply the rule, an increase in assets. So an increase in assets, your expenses or your withdrawals, you are going to debit. Increase, you're going to debit. Increase in your assets, withdrawals or expenses, you're going to debit. So here, cash is an asset, we're going to debit it. Then we said increase in sales, income, revenue, liability, you're going to credit it. And in this case, we are crediting sales. Fourth one says ABC purchased computer for 7,000 in cash. So now this is a purchase, cash purchase. So we have cash purchase. So there's cash and there's purchase. Purchases of computer. We know what has been purchased. So here we have computer. So we have cash has, so because cash payment was paid in receipt of computer, what it means is that cash reduced. Now we have computer. So assets, which is both of them are assets, computer and cash are both assets, right? Asset. But in this case, cash asset has reduced, has decreased. We're going to credit. But computer, which is an asset, has increased. Now we have computer that we didn't have before. We're going to credit that. And then the final one says ABC Limited sold goods worth £9,000 to customers on credits. Sold goods worth £9,000 to customer on credits. So the two aspects of transaction is we have sales. Sales, we don't know what goods this is, so we call it sales. But instead of us receiving cash, this was on credit. And those sales on credits, we call them trade receivables, because we're going to receive those money in the future from our customers. So we have sales. Sales is an income. We said that earlier on. An increase in income is going to be credited. Trade receivable is an asset because they are debtors to us. It's an asset. An increase in asset is also going to be debited. So we have debit entry here. So you see that for each of these examples that we have looked at, the rules applied. For every credit entry, there is a corresponding debit entry. For every debit entry, there is a corresponding credit entry. Okay. So we continue from there. Based on the examples that we have looked at, how comfortable do you think you are in following all of the 4 steps? The first one is you want to identify the 2 transactions. Is it cash, sales, withdrawals, trade receivables, trade payables, bank loan? What type of, what aspect of transaction is it? Which of the groups of accounts will you classify those transactions as? Is it an asset? Is it a liability? Is it an income? Then, has there been an increase or a decrease? And then you apply the rule. So I want you to reflect on this. How comfortable do you think you are? If you're not very comfortable, please pause it and go back to the exam to repeat, to try to work it again. But the basic rule is, if it is an asset, if there is an increase in assets, increase in expense, or increase in drawings, you have to debit. If there is a reduction in assets, expenses, drawings, you have to credit. If there's an increase in liability, income, revenue, capital, right, you're going to, an increase in that, you're going to credit, but a decrease in that, you're going to, so when I mean that, decrease in liability, income, revenue, or capital, you're going to debit. Let's record the transaction into the journal entry. That's what we're going to do. Okay. So for our first, the first example we have, which we have just followed, we just followed the steps now, understanding where we should, debit, credit, and all of that. So in posting into the journal entry, the first transaction is that, we have identified rent and cash, and we have said that, there was an increase in rent, which is an expense, and there was a decrease in cash, which is an asset. So therefore, we have said that, rent should be debited while cash should be credited. So you see that those two entries, we have then, recorded that in our journal, entry here. So in our journal entry, we have the date, the description, the transaction, the folio number, the debit and the credit side. So that's what we have in our journal account. And here we have the rent and the cash for the first transaction. The second transaction, we had identified bank loan and cash. So we had said, which of the accounts should be debited and credited. We said cash should be debited because there was an increase in cash, but there was an increase as well in liability. So that should be credited, bank loan. And the third transaction, ABC sold goods worth 4,000 in cash. We said, both the two sides that were affected, the two aspects of transactions were cash and sales. There was an increase in cash, so we have debited cash here, and there was an increase in sales. Increase in sales, income, revenue, capital, liability should be credited. Fourth transaction, purchases of computer in cash, using cash. So cash was, used to buy computer, so the cash amount has reduced. We said that should be credited, while our computer, which is an asset, has increased, with that should be debited. So we can see those entries, they're recorded in the journal entry. And then of course the final one, which is we sold goods on credit to our customer. The customer whom we sold goods to is now our debtor. And that's account receivables, which is an asset to us. Increase in assets is debited. Sales, increase in sales, 9,000 is also credited. So this is our journal, entry. So I just want you to pause, to see that you really understood this. Otherwise, please go back to the examples that we have done earlier on to be able to cut paste with that. We then move to, an example where you then be able to reflect what we have done so far, in the example. So let's say this example. Okay, so in this example, we have a number of transactions from September 1st to 31st of September. We have here, Mary started a bakery by putting in £25,000 into the business. So Mary started this business by putting in £25,000. The first thing you want to do is you want to identify the two aspects of the transactions. Here we have capital, because we said capital is owner's contribution, owner's input in the business. So Mary, who is the owner, has started this business with 25,000. So we have capital. Capital has increased. So we said increase in capital, sales, income, revenue should be credited. So we'll put in here capital. We'll put in here capital, and then we read here that Mary started this business with 5,000, but that amount was put into the business bank account. So it means the second account is what the bank. So money in bank has also increased. Money in bank is an asset. So bank, increase in bank, which is an asset, is going to be debited. So here we have bank here debited, and we'd have here capital credited. So now give it a try. Give the other transactions a try. Question. September 3rd, equipment was bought on credit from suppliers. What are the two accounts that you would have identified. Debits, credits, purchase. So credits from our supplier, that will be account payables. So we have an account payables, increase in liability. So account payables are liability, increase in liability is going to be credited. So we should have account payables here. But equipment was bought. So equipment has increased and equipment is an asset. Increase in asset should be debited. So give it a try and fill up, the other transactions. How would you, classify each of those transactions? 4th of September, we drew £150 cash from the bank to put in the till. So £150 was taken out of bank. So bank is an asset. There has been a reduction in bank. So reduction in bank should be credited, which is an asset you credit. So bank should be here. And then that cash that we drew from bank, we took it to the till. Now we have cash in hand. So cash we have at hand has increased. Cash is also an asset, but we have an increase in asset. Increase in asset, cash should then be what? Debited. So we'll have cash here. So finish up the others, you see that, just as we had mentioned, we have bank and capital, equipment and account payables, cash and bank. And of course, the other one, 7th of September, you bought motor vehicles. So motor vehicles and asset, equipment has increased. Increase in an asset should be debited. That goes straight away. You bought it by check. So money in bank will reduce. Money in bank is an asset as well. And then you credit assets, reduction in asset, bank, 6,800. So we have bank here. Sold some unused equipment for 1,100 to a customer on credit. First thing we can see is there is a credit. So when we have credit, customer is owing us as an account receivable. An account receivable is an asset. Increase in account receivable, which is an asset to us, we have to what? Debits. So increase in assets with debits. And then this unused equipment was an asset to us. It was an asset that we are no longer using. So now there is a reduction in the number of equipment we have. We're going to credit it. Reduction in assets should be credited. So credit equipment. So please go on with the other ones to see how, those transactions are to be recorded into our journal entry. Basic thing to remember is, the rule. This is summarized as debt click, and what it means is that for every increase in either, so for you debit every increase in expense, asset, and drawings, you credit every increase in liabilities, income, and capital. So any increase you have in expenses, assets, and drawings, that should be debited. Any increase you have in liability, income, and capital should be credited. So that would help us to, remember how to apply that rule. So that will be all for the first aspect of our, accounting cycle, which is identifying transactions as well as recording it in the journal entry. In the next video, we'll be discussing about posting transactions into the ledger account. I'll see you then. Have a great time.